What if I told you that the very thing that keeps most people financially stressed is the same thing the rich use to build massive wealth? That thing is debt. For many, debt is a four-letter word, a source of anxiety, and a major roadblock to financial freedom. And the numbers are staggering. As of late 2025, total household debt in the United States has soared to a record $18.59 trillion. The average American consumer is now carrying a debt balance of over $104,000. We see this burden across every category. Credit card debt has hit $1.23 trillion. Auto loans stand at $1.66 trillion. With delinquency rates on the rise, it's clear that many households are struggling. But this isn't just a story about numbers. It's a story about psychology. For the average person, debt is often an emotional trap, while for the wealthy, it's a strategic tool. My name is Nick, and I spend way too much time thinking about how rich people use debt. If you're someone who feels like debt is always pulling you backward, like no matter how much you pay, you're stuck. Make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Today, we're going to break down exactly how rich people use debt differently. We'll look at the data and the strategies, but most importantly, we'll explore the mindset shift that turns debt from a burden into a wealth-building machine. And just like any powerful tool, we'll also cover the risks, because using debt the wrong way can be financially devastating. The Great Divide: good debt versus bad debt. Before we dive into strategies, we need to understand the fundamental divide, which is rooted in two completely different mindsets. The psychology of bad debt. Bad debt is debt used to buy depreciating assets or for consumption. Think of that $1.66 trillion in auto loans for cars that lose value the second they're driven off the lot. Or that staggering $1.23 trillion in credit card debt, which often carries high interest rates and can be a significant drag on your financial progress. But why do people take on this debt? The drivers are almost always emotional. Instant gratification. The desire for immediate pleasure can lead to impulsive purchases and overspending. Emotional spending. Many people engage in retail therapy to get a temporary mood boost or escape from stress, boredom, or sadness. Social pressure. In a world of curated social media, the fear of missing out, FOMO, and the pressure to keep up with the Joneses can drive people to spend beyond their means to project a certain image. This creates a debilitating psychological cycle. The initial pleasure of a purchase quickly gives way to the stress, guilt, and anxiety of repayment. This financial pressure can lead to a sense of helplessness and even depression, making it feel overwhelming to even start a repayment plan. This mindset is rooted in short-term, consumer-oriented thinking and is often compounded by lower financial literacy. The strategy of good debt. Good debt, in contrast, is debt taken on to acquire assets that have the potential to increase in value or generate income. The goal is for the return on the asset to be greater than the interest rate on the debt. This is where the wealthy focus their attention. This approach isn't driven by emotion. It's driven by strategic calculation. It requires a completely different mindset. Long-term ownership. The wealthy operate with an ownership mentality, understanding that money can be put to work to generate more money. Delayed gratification. They are willing to forego immediate consumption to invest in assets that will grow over time, understanding the power of compounding. Financial neutrality. They view debt as a tool, not a moral failing. The key question is always, will this debt increase my income or long-term security? Think of it this way. Bad debt is driven by emotion and makes you poorer. Good debt is driven by strategy and has the potential to make you richer. Part 2. The wealthy's playbook for using debt. So, how exactly do the rich put good debt into action? It starts with a foundation of high financial literacy and a calculated approach to risk. They don't fear risk, they manage it. Let's break down their two primary strategies. Strategy 1. Real estate leverage, the BRRRR method. Real estate is a classic example of using other people's money, OPM, to build wealth. A powerful strategy for this is the BRRRR method: buy, rehab, rent, refinance, repeat. It's a system designed to recycle a limited amount of capital to acquire multiple properties. Here's how it works, step by step. 1. Buy. The process starts by finding a distressed or undervalued property and purchasing it significantly below its after-repair value, ARV. A common rule of thumb is the 70% rule. You should pay no more than 70% of the ARV minus the estimated rehab costs. For example, if a property's ARV is $300,000 and it needs $40,000 in repairs, your maximum offer would be $170,000. Because these deals require speed, investors often use short-term financing like hard money or private money loans. 2. Rehab. This is where you force appreciation by renovating the property. The key is to focus on durable, functional upgrades with a high return on investment, like kitchens and bathrooms, rather than over-improving for a rental. A contingency fund of 10 to 20% for unexpected costs is crucial. 3. Rent. Once the rehab is done, you must place a reliable tenant to generate a consistent rental income stream. This cash flow is critical because most lenders won't refinance an empty property. 4. Refinance. This is the most important step. You replace the short-term loan with a long-term, traditional mortgage via a cash-out refinance. The new loan is based on the property's new, higher appraised value. Lenders will typically loan up to 75 to 80% of this new value. If done correctly, this new loan pays off your original financing and returns all of your initial investment capital back to you in cash. To qualify, lenders look for a good credit score, cash reserves, and often require a 6 to 12-month seasoning period of ownership. 5. Repeat. You take the cash you pulled out from the refinance and use it to buy the next property, starting the cycle all over again. The risks and how they're managed. BRRRR is powerful but risky. Key risks include the property appraising for less than expected, renovation costs spiraling, or market fluctuations impacting rents. Successful investors mitigate these by making conservative estimates, having contingency funds, and building a reliable team. Strategy 2. Business loans, fueling growth and expansion. For entrepreneurs, debt is often the fuel for growth. Instead of growing slowly with profits, they take out business loans to accelerate expansion. And the core principle is simple. The return on investment, ROI, from the borrowed money must significantly outweigh the cost of borrowing. They calculate this meticulously. The basic formula is ROI equals net profit from investment / cost of investment, x 100. A $100,000 loan for new equipment at 8% interest is projected to increase net profits by $30,000 a year. That's a 30% ROI, making the debt highly profitable. They use various types of financing for specific goals. SBA loans, government-backed loans with favorable terms used for major investments like real estate or equipment. Business lines of credit, a revolving source of funds for short-term needs like managing cash flow, buying inventory, or funding a marketing campaign. Private debt, flexible capital from non-bank lenders, often used for large-scale growth like mergers and acquisitions, M&A. The risks and how they're managed. This strategy is risky. If growth projections fail, the debt remains. Successful entrepreneurs manage this risk obsessively. Monitoring financial ratios. They watch key metrics like the debt-to-asset and interest coverage ratios to ensure the business isn't over-leveraged. Conservative projections. They use conservative revenue forecasts to build a buffer against unexpected downturns. Hedging. They might use financial instruments like interest rate swaps to protect against rising rates on variable rate loans. Aligning debt to assets. They match the loan term to the asset's life, using short-term debt for short-term needs, like inventory, and long-term loans for long-term assets, like a building. The buy, borrow, die strategy. There's one more strategy, used by the ultra-wealthy, that perfectly illustrates the mindset of using debt as a tool. Buy, borrow, die. Buy. An individual buys an asset expected to appreciate, like stocks or real estate. Borrow. Instead of selling the asset and paying capital gains tax, they take out loans against it to fund their lifestyle tax-free. Die. Upon death, the assets pass to their heirs. The stepped-up basis rule resets the asset's cost basis to its market value at the time of death. The heirs can then sell the asset and pay little to no capital gains tax. This is the ultimate expression of the ownership mindset, using debt to unlock an asset's value without ever giving up the asset itself. From debt trap to debt tool. So what's the key takeaway? The rich aren't afraid of debt. They're strategic about it. We started by looking at the record $18.59 trillion in household debt, much of it causing stress and anxiety driven by emotional spending. The wealthy have a different relationship with debt. They see it not as a way to fund a lifestyle they can't afford, but as a powerful tool to acquire assets, generate income, and build long-term wealth. This doesn't mean you should go out and take on a mountain of debt tomorrow. The first step is to get control of high-interest, bad debt. Here are 2 proven strategies to do just that. 1. The debt avalanche, the mathematician's choice. This method focuses on paying off debts with the highest interest rates first. You make minimum payments on everything, then throw all extra cash at the highest interest debt. Pro. It's the most efficient approach, saving you the most money in interest and getting you out of debt faster. Con. It can feel slow if your highest interest debt is large, which requires discipline and patience. Best for people who are motivated by numbers and long-term optimization. 2. The debt snowball, the psychologist's pick. Popularized by Dave Ramsey, this method focuses on paying off your smallest debts first, regardless of interest rate. You list your debts by balance size and tackle the smallest one first. Pro. Paying off a debt provides a quick psychological win, building momentum and confidence. Con. It's mathematically inefficient, meaning you'll pay more in interest over time. Best for people who feel overwhelmed and need those early, tangible wins to stay motivated. Once you've eliminated bad debt, you can begin to think like the wealthy. How can you use good debt responsibly to build your own portfolio of income-producing assets? Shifting your perspective on debt can be a game changer. Here's what most people don't realize. Debt isn't the enemy. It's a tool. But like any tool, it can hurt you if you don't know how to use it. So don't just watch this and move on. Audit your debt, kill the bad stuff, and start using debt to build, not burn. Because your financial future isn't about avoiding debt. It's about mastering it. Thanks for watching. Don't forget to like and subscribe for more data-driven financial insights.